Okay, so good morning, everybody. This week, this is Andrea Everett with Prairie View A&M University Cooperative Extension Program with the Community Economic Development Unit. On the line, we also have Madeline Serra, who is the CEP 4-H agent for El Paso County. This week, we will be reviewing the module Thinking Like a Lender. So we'll go ahead and get that started. Okay. So this module is going to be helping you guys to understand some of the key credit-related factors that creditors and lenders use to evaluate your credit worthiness when making decisions about extending credit and approving loans and mortgages. So this module is going to be based more on the process of home ownership. So we're going to have a lot of home ownership examples, but this type of evaluation is used in a lot of different types of loans as well, business loans, things like that, okay? So after completing this module, you guys should be able to explain how lenders and other financial institutions determine creditworthiness, describe the 4 primary factors of creditworthiness, and then use a debt worksheet to calculate total overall debt. We're going to briefly go over that debt worksheet. If we were in a face-to-face learning environment, then I would probably print that up for you and have you guys fill that out. But I'm just going to kind of briefly describe that when we go through that, okay? And then the module topics are going to be the 4 C's, and the 4 C's are capacity, capital, credit, and collateral. Okay, and this topic also includes activities to help you simulate real world scenarios with your participants, okay? So with you guys. So the 4 C's of lending. So you guys, I'm going to introduce you to the 4 primary factors lenders and creditors consider when determining your creditworthiness. So some basics of the 4 C's are, and in referring to home ownership type lending, getting a mortgage is based on many factors, including the risk the lender takes on. The 4 C's of lending are, again, capacity, capital, credit, and collateral. And these are primary factors that are considered by lenders when determining your creditworthiness. There's an automated underwriting systems that are designed to speed up the lending process by assessing the borrower's information and associated risk to the lenders of the borrower's ability to repay the mortgage. So I think sometimes we hear about algorithms and different types of like computer-based systems that analyze data and talk about and figure out, you know, based on what you give them, either your banking assets or, you know, any type of stocks, bonds that you have that's inputted into the system, and the bank kind of pushes out a determination if you're creditworthy, right? It used to be that you could establish a relationship with a bank, and if they knew you, then they would take that risk on you, risk for you. But nowadays it's not like that. You go through, if you pass the algorithm, you know, through the bank and pass that underwriting system that's computerized, it's computer based, then you can probably get a loan. If you don't, then you won't get the loan. So those automated underwriting systems, they don't use factors such as a borrower's race, ethnicity, age, or any other factor prohibited by fair housing laws to approve or deny a loan. So they're good and bad, right? Because, you know, the United States has a history of not giving home ownership loans and things like that to certain races, and that's why these fair housing acts were enacted, right? But you do have to meet a level or a threshold for that automated system, okay, to be considered. So that. Let's see. Okay, so let's get into it. So the first one is capacity. So the first one is capacity. Okay, I guess somebody got kicked off but is back on. So when making a decision about whether or not to approve your loan request, lenders and other creditors will look to see if you have the capacity to repay that loan. So one of the ways that lenders verify your income is by reviewing several years of your federal income tax returns and W-2s along with current pay stubs. So you have to have qualifying income, and that qualifying income is evaluated based on your income source, the length of time in which it has been received, so how long you've had your job, and how long that income is expected to continue in the future. So if it's a part-time job or it's a full-time job, maybe it's a contract job, you know, all those types of factors are going to be used to determine if you can pay that loan back. The housing expense ratio is based on the total house payment. And then total house payment includes principal and interest, property tax, homeowner insurance, and private mortgage insurance. Housing expenses should not exceed 28% of your gross monthly income. And lenders review your recurring monthly debts or liabilities such as your car payments, your student loans, any child support you're paying, credit card payments, etc. Okay? And then other factors that they use are your debt to income ratio, and that is the sum of all reoccurring monthly payment debts, including the new house payment divided by your qualifying, that grows your monthly income, okay? So just to kind of start, you know, a little bit of discussion, what do you think are some factors lenders consider when deciding on a loan application? What do you think a lender would look at in deciding a loan application?
Maybe the credit report.
Okay, your credit report. What else, guys?
How good you are at paying things off.
Okay.
If someone already said credit report, right?
Yeah. Yes.
If you have a good source of income.
Yes, right? How are you going to pay it, right? You have to have a good source of income. You have to make enough money to pay for the house that you're trying to buy or the car you're trying to buy, okay? So, you know, when we're talking about capacity, some definitions that we want to define here are, and some you've heard before, you know, and it's like beating a dead horse, right? But loan, so that's money you borrow from a financial institution with a written promise to pay it back later. With a loan, financial institutions will charge you fees and interest to borrow the money. And then capacity. Capacity is another term for income, right? So we talked about that. Your income, your source of income, you know, your ability to pay back loans, that's all capacity, right? So capacity is another term for income. Lenders examine the ability of a potential borrower to demonstrate that his or her income is sufficient to repay a loan. Okay, so continuing on with capacity. Some more terms. Your gross monthly income, that's the income you earn in a month before taxes and other deductions. Under certain circumstances, it may also include your rental income, your self-employed income, income from alimony, child support, public assistance payments, and retirement benefits. Your housing expense ratio, that's the percentage of your gross monthly income that goes toward paying your housing expenses. And then the principal is the actual amount of money borrowed or the remaining amount of the loan that has not yet been paid back to the lender. Okay, so the principal balance of a loan is the borrower's debt. That doesn't include your interest, okay? So that's added on top of the loan. And so your interest is a charge for someone else's funds. Interest is typically indicated as a percentage of the amount borrowed. So again, when you're buying a house, when you're buying a car, when you're buying a boat, you know, based on your credit report and your credit score, your interest is going to be higher or lower. And if your interest is really high, then you're not paying back on the principal of the loan, right? So you're not paying on your debt. You're paying interest and they're just making money off of you. So it's really important to make sure that your credit score is high, and that you're improving your credit all the time, and that you're able to pay more on the principal of your debt and not just the interest. Some other terms here are homeowners insurance, and the homeowners insurance is a policy that protects you and the lender from losses resulting from things like fire or flood, which can damage the structure of the house and create liability such as injury to a visitor to your home. So if somebody gets hurt in your home, they can sue you, right? So that could cause a liability. If you have homeowners insurance, that could protect you from that, right? Any damage caused to your home or theft of your personal property, such as furniture, clothes, or appliances, homeowners insurance will cover all of that. Okay. And then there's something called private mortgage insurance, or PMI. Private mortgage insurance, or PMI, is a type of insurance which helps to protect lenders from losses in the event that a homeowner defaults on his or her mortgage and loses his or her home to foreclosure. So PMI is generally required by lenders when a homeowner pays less than 20% as a down payment on a loan. PMI coverage will cost approximately 1% of the loan amount up front, plus an additional 0.50% annual premium paid monthly. So the annual mortgage insurance premium may be canceled when the mortgage amount is reduced to 80% or less of the property value. Okay, so this is a way that, if you put 20% of a down payment down, then they probably won't make you purchase that PMI. But if you're only putting somewhat like between 5 and 20%, then they could have you purchase this private mortgage insurance, and that's just another expense on top of your loan. Okay, so to put it in terms of monetary amounts, say you buy a house for $120,000, okay, and you put 5% down of 120, that's $6,000. So that's a lot of money, right? But if you put $20,000, that's $24,000, right? So that's even more amount of money. So chances are that you're probably going to have to pay that PMI insurance that will be rolled into your mortgage amount, depending on who your lender is. Okay. Okay. Continuing with capacity. So, in addition to housing expense ratio, the lender will look at your recurring monthly debts or liabilities. Okay, so a debt. What's a debt, guys? We've talked about this several times.
An amount you owe a financial lender?
Right. Okay, so it's what is owed to a person or institution for obtaining merchandise or services without immediately paying for them. And then, usually a debt is required through a loan or the use of credit. Who can define a credit report for me?
A what?
Credit report?
Oh, sorry. A report of stuff you've bought in the past
Right.
and the credit you've gotten from it or not gotten from it.
Okay. So a more defined definition would be that a credit report provides a history of your use of credit, and it's a file maintained by a credit reporting agency that contains information about a person, such as where the individual works and lives, information reported to the credit reporting agencies by creditors regarding money borrowed and payments made, and then public record information such as bankruptcies and things like that. Okay, late payments, how much of a credit history you have, right? If you're barely establishing your credit, that's going to be on your credit report. So that's the length of your credit, the history length of your credit. And then the amount of your credit, right? So depending on how much credit you have and how much, debt you have, okay? Okay, so right here, all of these are listed that can be debts: your car payments, student loans, credit card payments, personal loans, all of these things we've already kind of talked about, okay? So continuing.
Miss, Miss Andy, I don't see anything.
You don't see anything? Does
No, I
everybody
just
else? How is everybody else? Does everybody see the screen? It should be on capacity continued debt to income ratio.
I can't see it, ma'am.
No?
Mm-mm.
Me neither.
yeah, I don't see it.
Andy. Are you there?
Yeah, I'm here. I think that somehow
Miss Sandy,
yes.
Now we see it.
I'm starting to see the screen, Miss Sandy.
Okay.
Yeah, me too.
Okay, for some reason it stopped sharing. Let me get back to where we were. It's still loading. We were here. Can you guys see that?
Yes.
Okay, so we're
Yes.
talking about debt to income ratio. Sorry about that, guys. Okay, so a debt to income ratio, and this is going to start getting a little bit more complicated. But the debt to income ratio is a mathematical calculation of debts to income. So your debts are divided by your gross income, so that's before taxes, okay? And then it's equal to your debt to income ratio. So typically the credit industry recommends that no more than 20% of one's net income should be spent on long-term debts, excluding a home mortgage, okay? Here is many mortgages have different minimum credit requirements. So again, with your credit score, you guys know that that's a numerical value determined by a statistical model based upon past credit behaviors, and that predicts the likelihood of your future loan default, okay? So the higher your credit score, the less likelihood of a future loan default. And then your down payment, right? So lenders are going to want, especially on a home mortgage, how much of a down payment will be required as a result of your credit score, okay? So the higher your credit score, maybe the lower the down payment amount, okay? So that down payment is a portion of the price of a home, usually between 5 and 20%, not borrowed and paid upfront. So, you know, if you're being asked to put 5% down, again, my example of that 120,000 mortgage, you know, 5% is $6,000. So when you're looking to buy a home, you need to save up a good amount of money to be able to put that down. Okay. Okay. So here is the debt worksheet that I was talking about earlier. Usually if we were in a in-person class, I would print this out for you so you guys could fill that out. But, and let me make this a little bit bigger for you guys, just so you can really see it. Okay, so, you know, we would have your name and your type of account, and then what interest rate you had for that account, what your monthly payments amount were, and then the remaining balance owed, okay? So we would use this worksheet to list all of your debts or your financial obligations that you pay on a normal basis. So what they're just trying to determine here is if you have too much debt here and you're not having enough income coming in, then you're probably not going to be able to pay that monthly payment for a home loan, right? So the less debt you have and the less interest rate you have that you're paying more on the principal balance, then the more chances you have to be accepted for a home loan, okay? So this is how they would calculate this for you, okay? So you would have that, like just like how I said here, okay? And usually I would have you guys look over this. Of course, you don't have a lot of debt, but in this situation, I would probably ask you to fill this out maybe with your parents so that you could determine, you know, what type of accounts they have, how much interest rates they have, the payment amounts, and then the balances that they owe. And so that you could determine your debt to income ratio. Okay? Okay, so we're, oh, here. Okay. So this is a larger one here. So then you would have your total monthly debt payments here, and then your total indebtedness, right? So these are all the payments you make, but this is still like the principal of your loans here, okay? So you would have that there. So they would know how much money you still owe, how much you're paying, and then figure out if you can actually afford the home loan and the monthly payment, okay? So here we're getting to a self-check point. Maddie's gonna go over this with you guys.
Okie dokie. The percentage of your gross monthly income that goes towards paying for your house expenses is called the house expense ratio and is based on the total house payment, which includes principal and interest payments on the loan. Does it include that?
Yes.
Good. Monthly property taxes?
Yes.
What do you think, Robert?
I'm sorry, miss?
Do you think it includes monthly property taxes?
Yes.
Good. Amount of debt? What do you think, Dominic? Nope. Can't hear me? What? Anybody else? What do you guys think? Amount of debt? Is it included?
Yes.
Are you sure?
No. No. I don't think so. Oh wait. Well, isn't that the expense? The debt?
No. No, sir.
Oh, okay.
No, so that's not included, okay? The amount of debt is not included. What about homeowners insurance?
Look, you have to apply for it, don't you?
Yes.
Okay. So I guess yes.
Yes, sir. Okay, mortgage insurance? What about you, Jacob? What do you think? Jacob, are you there? Can they talk?
They should be able to. Just unmute.
Or who else? Who wants to answer? Mortgage insurance?
What's the question, miss?
So the percentage of your gross monthly income that goes towards paying for your house expenses is called the house expense ratio, right?
Yeah.
And it's based on the total house payment, which includes, do you think it includes mortgage insurance?
Yes.
Yes, correct. Other special assessments. What do you think?
So HOA, just as a side note, is your home ownership association dues. So sometimes when you live in a fancy neighborhood, you'll have a home ownership association dues on that.
What do you guys think? Yes or no?
Yes.
Well, doesn't it depend? It depends on where you live, right? So I'd say no.
What do you mean depends on where you live?
Well, the homeowners. Oh wait, no. The HOA dues association. Isn't that where you depends on where you live? Because some areas don't have it.
Yeah, but this is just like in a perfect world type of scenario. So if you have other
Okay, well
special
then
assessments,
yes.
So yes? You believe yes? Okay, so the only
Yes.
one that wasn't included was the amount of debt, okay? The amount of debt you owe does not factor into the total house payment, but it factors into your debt to income ratio. So the total house payments include principal and interest payments, monthly property taxes, homeowners insurance, mortgage insurance, and other special assessments such as HOA dues. Okay?
Yes, ma'am.
Awesome. Good job, guys.
okay. Okay, so moving on to the second C, which is capital. So, capital is another term for the cash needed to close on a property, including the down payment, your closing costs, and any other reserves, okay? What do you guys think would be an acceptable form of capital?
Are the three options which one we can say? Which
You can
one?
say one of those, but if you guys have another one.
Okay, well then I'd say grant or matching fund programs.
Right. Okay, so there's a lot of programs that you can get a grant to start a homeowner's a home loan, right? There's programs that us as a unit promote, which are the USDA Rural 502 and 504 plans, and those are programs directly from the USDA that help potential homeowners in rural areas build a home, and they're at very low interest rates, right? And so a lot of times you can get that grant and have like 2% down, 1%, or even not have to put any money down through that program, okay? So this could include gifts from your family members, the down payment assistance programs also, and then other cash reserves can be that you can demonstrate to the lender that you have responsibly managed your money and have savings and other assets to fall back on in case of emergency. So when we looked at earlier, let me move back up. When we looked at, where was it? Maybe it wasn't here. Okay, maybe it wasn't here. Sorry about that. But we looked at different types of capital, which could be stocks and bonds, any type of savings accounts, things like that. Real estate property is capital. Say you have a car that's already paid for, that's an asset for capital. All of those can be capital, okay? Okay, and then moving on, here is where it is. Money market funds, things like that, okay? So lenders define investments to be individual retirement accounts. So IRAs, certificates of deposit, stocks, bonds, 401k accounts are all similar assets that can be used as capital, okay? Can you guys think of any other acceptable sources of capital?
Paid off items?
Yeah. Okay. And it's basically just because you can put that capital up as some type of collateral a lot of times. So if you're not putting down a down payment, that collateral is there. That capital is there as collateral. So if the bank, loses out on the house on the loan, then they can take that capital that you have to kind of get some of their money back, okay? So just a better definition of capital, that refers to the cash reserve, savings, investments, or assets possessed by an individual. When we're talking about some other definitions for housing, closing costs. So, when you're applying for a loan, a housing loan, you think, okay, I'm gonna put my down payment down. I'm gonna, usually have to get a house to be examined, or you have to have I can't think of the word right now, like a foreman or something come in and inspect the house. So a lot of times the bank requires you to do an inspection of the house to make sure that there's no, depending on where you live, no structural damage to the house before they accept that loan. No, if you live in a more wooded area, like no termites, things like that that are really gonna, no real plumbing problems, stuff like that. That's what all the inspection is gonna do. But you also have things like closing costs. So closing costs are the cost to complete the real estate transaction, and these costs are in addition to the price of the home and are paid at closing. Okay, so when you sign that loan, you have to pay those closing costs. So they will include points, taxes, title insurance, financing costs, items that must be repaid or escrowed, and other costs. Okay. And then ask a lender or real estate professional for a complete list of closing cost items. So different lenders have different types of closing cost items. So depending on who you work with as a lender, you're going to have different types of closing costs. Okay. Savings. We've talked about this, an account where you keep money for safekeeping. What else? Okay, and then this individual retirement accounts, IRAs, is a tax deferred plan that can help you build a retirement nest egg, right? So that's just another type of savings, right? Except that when you have a savings account, you can go in there, and depending on your bank, because sometimes a bank will charge you if you take too many withdrawals out of your savings. But for the most part, savings you can take out, you can close at any time with no real consequences, right? But if you have like an IRA or you have a 401k, if you're taking money out of that, you're going to have to pay taxes on it, and there may be some kind of penalty on that, okay? So it's set up that way so that you leave your money in there and you don't take from that money, and you're able to build that nest egg, okay? So looking at this cash asset worksheet. And again, if we were in person, I would have you guys fill this out in person. But this is where you would use, see if they have a bigger one. Okay, so you would use this chart to document where you're checking savings and retirement accounts and balances, and so that you can determine what your net worth is, okay? So total down here. So depending on how many checking accounts you had, you would have your balance here. Determining how many savings accounts you'd have your balances here. If you have any mutual funds, stocks and bonds, you would have those accounts here, and then the amount here, the balances. Cash value of life insurance policies. So if you cashed out that life insurance policy, how much would it be worth? You would put that here, and then any other type of liquid assets, real estate, stuff like that, okay? And then you would total that up right here. Okay, so now time for another knowledge check with Maddie.
Okie dokie. Having an adequate cash reverses demonstrates to lenders that you have responsibly managed your money and have savings and other assets to fall back on in the case of an emergency. True or false? Jacob, you want to write in the comments if your mic doesn't work? Having adequate cash reserves demonstrates to the lender that you have responsibly managed your money and have savings and other assets to fall back on in the case of an emergency. True or false?
True.
Yeah.
Awesome.
Sure.
Great. Good job. Yes, true. Lenders typically look more favorably on your loan application if you will have cash reserves in the bank after closing. Cash reserves demonstrate to the lender that you have responsibly managed your money and have savings and other assets to fall back on in case of an emergency. Good job, guys.
Thank
Would
you.
an emergency like the coronavirus be one?
Yes.
Like you don't have a continuous income?
Yes. That's a very big emergency. So if you have cash reserves, I mean, you're going to be able to survive. And once we get out of this, the banks are going to see that you're handling your money very well. So they're more lenient towards you.
Mm.
Okay, So moving on, we're going to talk about another one of the 4 C's, which is credit, okay? So lenders will review your credit history to determine your overall creditworthiness. Your ability to secure loan approval will be hindered if a lender or creditor sees several late payments or other negative factors on your credit report. Negative factors on your credit report, also referred to as derogatory information. This information can legally be used to turn down a loan application. So this is what they're going to cite for when they, if you are rejected, if your loan application is rejected, they have to send you a letter saying exactly why they rejected it, and they could use those negative factors as a reason to say that you rejected it. Derogatory information includes late payments, charge-offs, bankruptcies, judgments, etc. And then
What's a charge-off?
remember we talked about that last week? Like when a like a creditor decides that you're just not paying it anymore, they'll charge off the account and then they'll start pushing it into the like sending it to a person that's going to try and get their money back.
Oh, okay.
Okay. And then as a general rule, derogatory information remains on a person's credit report for how long?
13 months or 7 weeks, I think.
It's 7, but not weeks.
Oh, 7 months?
Not months.
Years?
Yes, 7 years. Derogatory information remains on a person's credit report for 7 years. Okay. And then bankruptcies can remain on your credit report for 10 years. Okay.
Can you delete them earlier, or I guess like get rid of them earlier? What do you have to do to do that?
You would either have to pay them off or work with the creditor to get them paid off, to show that you're paying that off. Then they would report that. Or if you want to dispute that charge, you can dispute that charge. Say that there's some kind of inconsistency and you want to dispute that charge, you can do that with the credit reporting agency, but you have to have proof saying, you know, whatever your reason is or why it's wrong or something like that. If you can't just, I mean, you can, you know, dispute it, but if you don't have any evidence, then it's still going to stay on your credit report. Okay, so and then just as a review, what are some things that can hurt your credit score?
Not paying off loans in a certain amount of time.
Right.
Maxing out your credit cards.
Say that again, Robert.
Maxing out your credit cards, miss.
Yes, that could totally hurt your credit score. What else? Were you going to say something, Kira?
I forgot what I was going to say.
Okay. So on the other end, what actions can you take to improve your credit score?
You
Pay
can.
your, sorry.
Sorry, go ahead.
You can pay your bills on time.
Right.
Not pay the minimum.
Yes. Okay, so those are all good ways to improve your credit score, okay? I'm glad you guys are listening. Okay, so, you know, when lenders review your credit history, determine your overall credit worthiness, okay? So, you don't want any of these negative factors or derogatory information, right? You don't want any collection accounts, you don't want any charge-offs, you don't want any judgments. You definitely don't want any bankruptcies, and you definitely don't want any foreclosures, because these can severely limit your loan options for an extended period of time. So if you have those on there and you're not able to take them off of there, or you're not able to pay creditors back, those are going to be on there, and that's going to affect you for a long time, at least 7 years, right? 7 years for, you know, a loan that you're not paying off, and 10 years if you have a bankruptcy on there, right? So let's see. Let me give you a good definition of this charge off up here, okay? Since you asked about that. So a charge-off is the term used to describe loans or debts which have gone unpaid by the borrower. Simply put, in the case of a charge-off, the creditor gives up on collecting payment and reports the charge-off to the credit reporting agency for inclusion on an individual's credit report. Most lenders, however, regard charge-offs as debt which are still owed. So just because they say that you're not, they've given up on you paying it to them, it doesn't mean that you don't owe any debt, okay?
Okay.
So moving on to the third C. Actually, I think this is the fourth. Collateral. So do you guys need to get off at 5 till or 10 till?
Five feels good for me.
Yeah, same.
Okay, so we'll try and get through this pretty quick. Okay, so another factor in determining your credit worthiness is collateral. So collateral is the property that you pledge as a security for a debt. So when you obtain a mortgage, the collateral is the home you are buying. So if a borrower defaults on a loan, he or she could lose his or her home, okay? So most home mortgage lenders will make loans on 1 to 4 unit residential properties, which include single family homes, multifamily dwellings, up to 4 units, condominiums, and townhouses. So those are like duplexes and quadruplexes and things like that, okay? And then lenders also consider the condition of the property and any repairs that must be made in order to meet local housing standards or ensure the property is, can be lived in. It is also important to know about the structural condition of your home you purchased and the types of renovations and repairs you can expect to make immediately or farther down the road. So, if you're going to do a big renovation project, that's going to add to the value of the home, right? If you buy a house at a low rate that's maybe a foreclosed property that the bank is trying to sell off right away, but it's not in very good condition, but you're going to do some renovation to it, that increases the property of the home, and they want to know about that, okay? A whole house inspection report will provide you with all of the important facts about the conditions of the house from roof to foundation. Remember I talked about that earlier? And then lenders will order an appraisal to be completed by an independent licensed appraiser. So it is the appraiser's job to determine the fair market value of the property compared to other similar homes in the neighborhood. Okay, and appraisals are not a substitute for a thorough home inspection. Don't rely on the lender's appraiser to identify anything other than obvious flaws in the property. Okay, so you want to have your own independent inspector as well. Okay, because sometimes the bank isn't going to, you might not be on the same page of what they think that the appraisal of the property should be. Okay, so having that person to do that whole house inspection is going to help balance that out. Okay.
Okay.
Okay. So we talked about this going on. Concern buying an older home, you need lots of repairs that may not fit in your budget, okay? And then just remember that choosing a right home may take some time, but the wait is often worth it when you eventually find the best match for your situation, okay? So okay, so once the seller has accepted your offer, it is time to order a whole house inspection, right? This often must be done quickly since you may have only a few days to cancel the agreement based on the results of the inspection. So this is going to protect you. So say you're going to buy a house and you don't know that it has serious structural damage, right? That inspector is going to let you know. So if you find some kind of structural damage, then you can cancel the agreement. Okay, they give you a little bit of a window for that. And so the best person to do this type of inspection is a certified home inspector who has qualified experience and training in the business of home inspections, and then he or she will know what to look for as she goes through the inspection process, okay? The whole house inspection report will provide you with all of the important facts about the condition of the house from roof to foundation, and you need to know about the structural condition of the home and the types of renovations and repairs you can expect to make immediately or further down the road, okay? So, continuing with collateral, if you're ready to move ahead, the lender will order an appraisal at that time. So after you get your inspection, they'll order the appraisal, which is done by an independent licensed appraiser. It is the appraiser's job to determine the fair market value. We talked about this. And the appraisers are required to note any repairs that they see that need to be completed. So after you get this appraisal, the bank may require you to do certain repairs to fund this type of loan. So you need to know if you have this within your budget to do that, okay? And the appraiser will probably revisit the property and verify that these repairs have been made, okay? So most lenders require that the property be rated in good condition by the appraiser with all required repairs completed. So that doesn't necessarily mean you have to do it, but if you're buying it from somebody, they will have to do it in order for the bank to purchase that house from them, okay? And then it's also important to remember that the appraisals are no substitute for a thorough home inspection. And, don't rely on the lender's appraisal to identify anything other than obvious flaws in the property. So moving on to another self-check, knowledge check. Maddie?
Okay. Lenders and creditors consider 4 primary factors when determining your credit worthiness. The 4 C's of lending are, is it closing cost? Brock, you want to answer that? You think what closing costs one of the 4 C's? Okay, Jacob, no, good. No, closing cost is not one of the 4 C's. Can somebody tell me what closing cost means though? No?
When you buy a house or when you're getting a loan and when they're gonna accept the loan, you have to pay a closing cost.
Great, good job. Okay, moving on. Credit, is that one of the 4 C's?
Yeah, I think so, miss.
Yes.
Great, good job, guys. Capacity, is that one of the 4 C's?
No.
No.
Are you sure?
Yes.
No.
It is.
Oh, I don't
Kira,
think
you
so.
said yes?
Yes, it
Kira
is.
is correct. Good job, Kira. What about cosigners?
Ooh.
Is that one of the 4 C's?
No.
Can you
No.
tell Dominic, can you tell me what a cosigner is? Do you remember what a cosigner is?
Not quite.
Not quite. Does anybody else know?
Someone who signs on like a contract with another person,
Good.
or like
Good. Say you're buying a car and you need to borrow someone else's credit, they co-sign for you on that contract. Right?
right.
Okay. The next last 2, capital and collateral. Are those the last 2 4 C's of the last 4 C's?
Yes.
Good job, guys. Very good job.
Okay,
Good job,
so good job, guys. So we had credit, capacity, that has to do with your income. And if you have enough income to be able to say that you can pay it, the capital, any types of savings, IRAs, 401ks, properties, and then collateral, same thing, using your capital as a collateral, right? Or in the process of a home loan, the house is actually the collateral. So if you default on that home loan, the bank's going to take your house, which is not something that we want to do. Okay, so we've come to the end. Thinking like a lender module. The goal here was to help you understand how lenders and other financial institutions determine your credit worthiness. And by understanding the key credit related factors and tools utilized by lenders and creditors, you guys are going to be more prepared in the future to successfully secure credit, especially at favorable terms. We don't want you with some high interest loan. We want you to be able to, finance at a low credit rate based on your credit history and your credit scores being at a high level, right? And then that's it. So we'll answer some questions after this. I'm going to stop recording. Thank you guys for joining us this week.
Good job,
You're
guys.
welcome.